none of this is rocket science. It just takes, a little bit of time and effort and networking and just learning the business and finding your lane.
Welcome to the Fully Funded Show. Whether you're a capital raiser, deal sponsor, fund manager, or LP investor, we've got the insights you need for investing success. Join Sam Silverman each week for expert interviews, insider tips, and strategies to fully fund your ventures. Let's go!
All right, we are back with the Fully Funded Show, this time with my friend Jack Krupey. Jack, thanks for coming on.
Thanks for having me.
Cool, Jack. So I want to give the listeners some background on yourself, where you are. I think your location story is really cool as well, so always feel free to share that.
Yeah, absolutely. So I'll start with how I got into real estate just after college over 20 years ago. I thought I was going to be in the computer IT industry, but it was during the dot-com crisis. So I ended up going to Vegas for my birthday. I bought one of those paperback books on how to make money in real estate, no money down, and came back to Rochester where I went up to college and talked to my college landlord. And about 3 weeks later, I owned a house, no money down. This was the freewheeling kind of, early 2000s where if you can fog a mirror, you could get a mortgage. So within a year, I bought 4 houses, no money down, and quit my IT job. And really just dove into all the traditional real estate that most people start in, just, being a single family property landlord, doing wholesaling, fix and flip, et cetera, and quickly realized like how much of a grind that is. And it's really difficult to scale. And then the 2008 kind of financial crisis happened and everything just froze. So what ended up happening is I was from outside of New York City, in New Jersey, and there were hedge funds in New York that needed people that had real estate experience because they were buying all the bad loans from the banks at pennies on the dollar. So I had no thoughts of ever working on Wall Street or in private equity, and I kind of backed into it as opposed to going through investment banking and all that stuff. I just sort of got in the back door and was managing hundreds of non-performing mortgages, foreclosures, et cetera. And then about a year and a half later, I left the firm I was at. I ended up partnering with a small family office, and we were buying a few $1 million of loans at a time. And then a private equity fund approached us and ended up partially acquiring us. And then we bought $3 billion of non-performing mortgages over the next 5 years. So it was a crazy ride, but eventually I realized I was not cut out for that kind of Wall Street grind. I got into real estate for passive income and to have a good lifestyle, not to sit at a desk and just be, stuck looking at spreadsheets and pivot tables all day. I'd started investing in multifamily and other real estate syndications passively while I was there. And then when I ended up leaving the firm and then they bought me out for a nice sum, I decided and from talking to some of the partners that we were investing with already, realized that there was a business around, investing into real estate syndications, helping raise capital, and becoming a partner with these groups I'd already had success with. So along the way, I also moved to Puerto Rico. I got tired of paying the 50% tax rate in New York City, and in 2019 or end of 2018, I moved down to San Juan, Puerto Rico. Now live a block from the beach. It's always 80, 85 and sunny, hurricane season. There hasn't really been a bad one since before I moved down here, knock on wood. But yeah, it's an amazing community down here. There's about 10,000 entrepreneurs who've all moved down here for the various tax incentives. And it's a really cool place to be.
Dude, so a few things I want to dive into there. I think the first thing is, could you help me understand what buying non-performing notes looks like? Right. I feel like a lot of people have heard about it recently, right? There may be some opportunity for it coming up here as well. Like, help me understand the mechanics as an investment of what goes into that.
Yeah. So, it's definitely not an efficient market. There's not an MLS or, one central place. But once you get into a network, there's a number of brokers, a number of hedge funds, number of servicing companies that have portfolios of loans. And, some of them are institutional level and won't talk to you if you're not going to buy $10 million. But there's others that, the loans tend to trickle down, and there's groups that specialize in selling one-off non-performing and performing loans or reperforming loans to more individual investors. What tends to happen is Wall Street doesn't like the lower balance loans. So Wall Street rather own a $400,000 house in a major state or major metro. But if a house is worth less than 100,000, it's often not worth their time. So they'll package up and sell loans to other funds. Then the funds will sell to individuals. So the actual purchase, it's a purchase and sale agreement, not too dissimilar from buying a piece of property. And you get what's called an assignment of mortgage, which gets filed at the county, similar to how a deed would get filed. And there are various loan servicing companies. We always recommend, I guess certain states, maybe you could self-service and just use like a software, but we recommend, especially if it's an owner-occupied property, to always use a third-party loan servicing company, and they'll have a 1-800 number, and they'll be the ones that the borrower calls. However, behind the scenes, you are the actual bank. So you can make the decision on, do you want to offer a loan modification? Do you want to perhaps forgive some payments or add payments to the end of the loan and re-amortize the loan over 30 years? You can do a lot and be very creative. And we actually, a lot of people thought we were, these vulture capitalists coming in here, but we actually helped a majority of the borrowers that we worked with. If they had the ability, if they could afford to make a payment, then we would make better deals with them than the prior bank would most of the time, because we'd already bought the loan at a discount. And so we had room to create a win-win.
Yeah, it makes a lot of sense, right? Like a lot of these banks are just tied with the regulations they have in terms of the structures they can go offer, the fees they have to go charge. So if you're going to get walking in at a really solid basis, you have that leverage and room and flexibility to go create something that still gives you enough margin. I'm sure you factor that into your deal as well as to how much room do we have to make this work, just for the confidence of the payments will keep coming in. We're going to looking at that spread for yourself.
Yeah, absolutely. And back in the early days, we would buy first position loans at 50, 55 cents on the dollar. And it was always of the lower. Right now, most properties have equity, but back then there were properties where somebody owed 300,000, but the house was only worth 2. So we would buy the loan in some cases for $130,000, but they still owed us 300. So we could do a lot. We could lower principal balances where some of the banks were not allowed to lower the principal balance without, they would rather sell it and take the loss and get the cash in hand than lower the principal balance, which then caused them issues, and their regulators would make them reserve more capital. So it was a great business. It's still viable, but it's not, like many businesses, it's been matured. There's not as many distressed loans right now. And, the residential sector is actually very strong. There's certain markets that were a little overheated post-COVID, but, largely a majority of homeowners have equity. I believe 40% actually don't even have mortgages, and roughly 30% locked below a 4% interest rate. So, overall, there's just not as much distress. There's always some distress. There's always death, divorce, other motivating factors, job loss, et cetera. But, overall, it's just, there's not as much, that was probably a once in a multi-generation cycle in 2008, at least on the residential side.
Sure. No, it makes a lot of sense. And I want to pivot back to a point you made as well, when kind of looking at the career you ended up in, right? In terms of going, yes, work in real estate, kind of using that as a vehicle to go the more the corporate type Wall Street route. And I think it's something, I'm curious to take this too, is people break into the space, whether it be capital raising or operating deals, having ownership in, projects or companies. And a driver of that is likely the freedom that comes with it, in terms of lifestyle piece of it, in terms of the ability to, really out earn the average hourly rate. But when you go to a company like that or go to a position like that, you have the same upside, if not more, but you may be essentially owned by them for a period of time. Like, help us understand kind of how you think about that balance, how that weighs in your decision-making as to how you want to go live your life today.
Yeah, I certainly, it's at the top of my mind for any decision I make now that I've, gotten cashed out. But, at that time, 2008, I took a few hits like many people did, and I hadn't really, built back up my, my net worth fully. So when we were doing that deal, I didn't really have the luxury of kind of negotiating my lifestyle. It was come in, grind, make things happen. So, I wish in hindsight, I don't know how much leverage I would have had, but I wish I had done a little bit better, planning and negotiating back then on sort of what I was looking for. But, New York just has its own unique work culture. There's just certain things that are just expected. And this was well before COVID as well. So, it was, the thought of kind of working remote 2-3 days a week and only coming to the office when needed wasn't as much part of the New York culture. And I think that's changed a little bit. I know, and friends I know that are still in banking is getting close to, at least for the junior people, back to 5 days a week. But I think there's a lot more flexibility now. Really, I spend a lot of time now just making sure I don't create myself a job I hate. And that includes the directions that our business goes. The business I'm in now, and the reason that we invest in larger professionally run syndications and funds is that, I've owned those single family houses, those 2-family houses. Even if you work for yourself, there's the saying that, some entrepreneurs work 80 hours a week for themselves so they don't have to work 40 hours for someone else. And, it's always in my mind of like, how do I, really focus on what I'm good at and not get sucked into what I'm not good at. I know I'm more of a connector, for those that are familiar with EOS, that visionary role. And, if I get pulled into the weeds and minutia and have to do repetitive tasks, I feel like I'm failing as an entrepreneur and a business owner, and I end up not happy, and I need to be able to buy back my time. So it certainly, made me say, no to things that sounded good and probably were good. But, as an entrepreneur, you have to be careful of that shiny object syndrome as well. And, it's helped me to be a little more laser focused on ensuring that we're, focusing on the core business. And if we're going into, something new, that, we're careful that there's not a lot of unintended consequences, or doesn't cause the mayhem in the business or cause me to get pulled into having to, do things that ultimately I don't want on my plate.
Sure. So now I'm looking at your business, right? Kind of being more of that capital allocator, fund manager, kind of partner type role. When you look at that role, there's a few pieces that are really important, right? One is, how do you go build and scale your base investors that want to keep partnering with you? And two, it's how do you go continue to find really quality partners and deals to invest into? So kind of looking at the latter piece of that first, like what due diligence do you do? What does that process look like? How do you make up your portfolio of people that you want to work with, and in turn bring to your investors as well?
Yeah, there's certainly an art and a science to it. And, fortunately, I had tested the waters informally just with my own money before this was as formal of a business. So I started with a number of groups that had already proven themselves to me. Once, we formed JCAM as more of an official business, I joined 2 different masterminds, attended a number of conferences, got to meet a lot of other allocators, investors investing their own money, and sponsors at various events. Continued to test the waters, with, in our first fund, I was the largest individual investor. So for our first fund, we did make a number of small allocations, in some cases 50 or 100,000, just to test the waters, see how the sponsors would perform, operate, report. And, over time it's gotten more sophisticated. Our analysis of underwriting, just after seeing so many deals, because, we've invested in over 50 deals, but we've seen hundreds and hundreds of deals across various asset classes, and, really been through being through this last interest rate cycle as well. This is about as big of a stress test as you could have when you see interest rates going from 0 to 5 across a few years. And we've seen seasoned, very large operators that have made the press that have, pretty much collapsed. And then there's, some smaller operators have done, really well and navigated and pivoted as needed. So, we've seen a lot. There's not, I know some people have 50-point checklists. It really comes down to, just confidence in the business plan, confidence that they know their numbers. Do we believe in the value add strategy? Because almost regardless, whether it's multifamily, whether it's mobile home parks, there's something to add value. There's got to be something where you're forcing appreciation and not just gambling on rent growth. And, a couple lessons that I think we've learned, especially from, some of the challenges of the last year or two. An operator that has liquid capital or a balance sheet that's not just a bunch of guys who clubbed up on a deal, because, when times get tough, an operator that has, millions of dollars that could inject $1 million themselves and not have to make a capital call. That's a couple of deals I'm in, that scenario has happened, and it's, the deals progressing, whereas maybe a new group who went to a seminar and just did it themselves might have failed. And then, who is the other base of investors? There's a very well-known group that's had a foreclosure or two that's been in the press, but the deals that we're in 3 different deals with them. We're in with a few other very large groups. So there were capital calls and they were made. And, I believe that it's going to give the deal enough time and enough capital that, ultimately we're still, hoping for a profitable exit, just because there were, that was $5 million that needed to be raised, but 3.5 to 4 million came from 2 different check writers who already had 10 million in the deal. So that really de-risks the deal when there's bigger pockets, not bigger pockets involved in it.
Sure. No, it makes a lot of sense. It's kind of who you partner with and what that backstop is. I think also the brand equity piece comes into play in a big way right now as well, right? Where people who have a social presence, have a brand reputation to go protect, I think right now is when those reputations are either protected or really crushed when looking at how they handle certain scenarios. But the ability for a syndicator to either, one, pump their own capital into a deal, or 2, the ability to go out and raise it from their connections investor base is huge when looking at if they ever have to go save a deal themselves.
Yeah, absolutely. And, I think this is enough public record, but as an example, I'll give a shout out to a group that I think has navigated pretty well. Tides Equities, who's had a lot of press, including some negative, has, done very well navigating that. We're in a few deals that they've had challenges, but they've, positioned themselves to last another 2 or 3 years. On the other side of the coin, unfortunately, we had one deal with a group called GVA, who, again, this is all public knowledge, it's in the press, but they've, had a number of challenge deals, and, one of which we were involved in. Fortunately, it's only about 3% of our fund, but, we've taken a significant hit on those deals, and it's tough. And, both had stellar reputations and near perfect track records up until a year or 2 ago. And, now there's been significant challenges. It's been really interesting to see how they've both navigated, and not to slam, GVA. Unfortunately, the specific deal we're in didn't go well, just as an example of, even what seems like a very well-seasoned sponsor with a great track record, when interest rates move 5% and, a group grows potentially too big, too quick, bad things can happen.
Sure. So a couple points there too is how'd they handle it with their investors, right? Being yourself, like what was the experience like? And then what was the experience like with you to your investors in terms of, I believe that deal was what, total loss in terms of capital on the equity side of it?
Yeah. That was, their communication, it was passable. It was, I think it could have been better, but certainly probably could have been worse given the challenges. But there was also somewhat of a take it or leave it. We're going to make this capital call. If you don't make it, the property is going to go back to sale. I was pretty surprised at how quickly they were, seemingly, and again, maybe a lot more was happening behind the scenes, but how quickly they seemed to be kind of willing to, ready to give up. And it was somewhat of just blaming the market as an excuse. Meanwhile, occupancy had dropped below 70%. I think part of the plan was to try to out renovate interest rates, to try to, get rents up as quick as possible. But unfortunately doing that, the occupancy dropped, and then the property ran out of money. So they, didn't manage, cash flow accordingly. And, was it rule number 1 of running a business is don't run out of money. And then rule number 2 is don't forget rule number 1. And then for our investors, I mean, fortunately, that was only part of the fund. So, we had to report the loss, but, it was 3% of the fund, and we had, a number of successful exits for the earlier acquisitions that actually, exited prior to interest rate moves. And, the fund has a bunch of fixed rate deals that have 7-year debt. So, that it wasn't catastrophic for the fund itself, which was very fortunate. But I feel for any investor who, only picked 1 or 2 deals to invest in and just, might have had 50, 100, 250 grand only in that property. That's, potentially catastrophic for them. So I do caution investors to, especially if you're, dipping your toe into the syndication side from, just moving money out of the stock market to diversify. Just think very much about how much you're budgeting. If you're going to move $500,000, yeah, maybe you can put put $100,000 into 5 different deals, but I caution a lot of investors not to put all your eggs in one basket to any one property, because even if it's not an operator, I mean, if there was the deep freeze in Texas, there's floods, there's things that, insurance generally may cover, but if there's a catastrophic loss, you still may not see cash flow for a year, or there could be a lot of time fighting insurance companies. So diversification and dollar cost averaging and be able to get into multiple properties over a period of 6 months to a year or a little longer is very, very important.
Sure. And with that in mind now as well, I know yours is a fund structure and diversified fund as well. Help us understand kind of how you think about the makeup of what goes into it. And your investors, is it the Jack Krupey fund where they can say, hey, we've got these 10 options, I can go pick where I want to put my capital? Or is it more so you go out and raise a certain amount of money and you allocate it as you see fit into deals? Like, what does it look like for you? And kind of why is that your strategy as well?
Sure. So we actually run 2 different funds simultaneously. We have one fund that is diversified and it's really our discretion, but we continuously raise for 12 to 18 months. So as capital comes in, we pick and choose between the best available deals we see and also just make our own decisions on portfolio construction. We're still over 50% multifamily, but we've invested in self-storage. We love the mobile home park space if we could find deals at the time, and we've even invested in a marina that has RV park component. I know some people have done ATM machines, some people do car washes. There's a lot of unique stuff out there. I love your one of your Airbnb is one of the strategies you've focused on. But for me, marinas has been ours because we're finding 10 cap entries with a value add component. And generally being bought from these mom and pop type operators that have owned these kind of family run marinas for a bunch of years. One of them in particular. I think there's huge opportunities. There's depreciations. It varies, but I mean, it's similar to, it's a lot of fixtures, a lot of, the docks are going to be, all certainly, fully, 1 year, 5 year life cycle. And then, one of them even had houseboats on it. So there is an Airbnb component potentially, for a houseboat sitting on a freshwater lake. So that fund we fully manage and provides diversification between likely there'll be 15 different assets or allocations in the fund. Separately, we have a customizable fund. Some may even think of it as like a crowdfunding platform, but we have a separate platform where it's a website portal where each various individual deals, often the same deals the fund will invest in. Almost always the fund will invest at least a little bit of money in anything that we have on our other platform. And that platform allows people to pick their individual deals and customize their fund and allocate as they see fit. And there's a combination of multifamily, self-storage, marinas. We have a hard money lending fund up there as well. So various options for investors that, are all deals that we've, met the sponsors, understand the sponsors, approved of the business plan, and, vetted. Again, there's only, we vet as good as we can. There's always risk in investing across the board. So it's not like there's never a guarantee in business, but, it's been vetted enough. I often have my own money. I invest generally through the fund, and then the fund is invested in the deal. So I have my own skin in the game across, generally anything that we're marketing.
Cool. Yeah. Super helpful to understand kind of the mechanics behind it. And I think it's nice to have for folks have the option too, if they want to go invest into the fund across all deals, or actually have the discretion to go pick their own, want to go heavier in certain things, lighter in certain things. So I think it's nice when it's good to cut a check for 50, 100K and be able to go be involved in 15 different projects, right? We're kind of looking at that side of it. As some deals perform above expectations, some at, and some below, right? I think kind of looking at it as a portfolio structure versus a single deal performance-wise can help quite a bit in this role.
Absolutely, especially in this scenario. If you're looking at your overall net worth, I harp on this a lot to just my friends, my colleagues, anybody I know who's got a 7-figure plus net worth, but has 100% of their money in the stock market, just in index funds, stocks and bonds, etc. That they're definitely under allocated to real estate and alternatives. The average, multimillionaire, somebody worth 10 to $50 million, generally most have almost half their money in real estate, private equity alternatives, as they scale into, level that's closer to having a family office.
Sure. And hey, before we hop off here too, what advice do you have for someone looking to get started either as an investor or more like that fund manager type role?
Yeah, you gotta get involved one way or the other. The simplest is listening to podcasts like this, getting on Bigger Pockets, reading various internet forums, buying books, local meetup groups. Almost every major city is going to have a meetup group for various parts of real estate. Going to live events as well, joining masterminds. All of those help build the foundation. You'll meet people further along, you'll meet service providers, and most importantly, you'll meet other investors that were in the same spot you were a year or 2 years ago that have taken different levels of action. You'll meet people who've raised millions or invested millions. You'll meet people who made one or two deals, and that's super helpful just to it takes the mystery out of it, and none of this is rocket science. It just takes a little bit of time and effort and networking and just learning the business and finding your lane. Everybody's got a different lane. There's, I'm super outgoing and a networking machine and enjoy that. But there's plenty of room in this business for analytical people. Every wild and crazy salesperson like me needs, a number cruncher and somebody to really, dive in and keep the wheels on the bus.
For sure. Well, Jack, what's the best way for the listeners to reach out to you?
So JKM Investments is our website. That's JKAM for JK Asset Management, which is the original company, JKM Investments. I'm also on all major social media, Instagram and Facebook and LinkedIn. I'm very active. We do have a TikTok account. I don't do any of the dancing, but it's up there as well.
Cool, man. Jack, thanks for coming on.
Thank you.
Thank you for tuning into the Fully Funded Show hosted by Sam Silverman. If you are enjoying the content, let's take your journey further in the Fully Funded Mastermind. The Fully Funded Mastermind offers more than just insights. It's a mastermind community designed to solve the real challenge of raising capital. By joining, you gain direct access to strategies, coaching, and a network dedicated to turning your financial goals into achievements. Don't let capital raising be a barrier to your success. Visit fullyfunded.capital to explore how our mastermind community can pave your way to financial growth.
Thanks for tuning in to the Fully Funded Show. If you enjoyed today's insights, hit follow, share with your investing pals, and drop us a review. Connect with us on social media for bonus content. Your success is our mission. Keep those funds flowing. See you next time.